Not to be alarmist, but judging by all that's currently ongoing, this storm cloud graphic art is in humanity's path forward, not in our recent figurative rearview mirrors. We have many important bullion-related news items to cover this week, as unprecedented fiscal, financial, economic, and monetary climate changes are afoot. The United States Biden administration proposed a new $6 trillion fiat Fed note budget, arguing their plans will make the USA more competitive. Aims at spending record sums on infrastructure, education, healthcare, and more will push federal U.S. government spending to almost 1/4 of the entire U.S. economic output, levels not seen since way back to World War II. The New York Times reported that the budget request, the first of Mr. Biden's presidency, calls for total spending to rise to $8.2 trillion by 2031, with deficits running above $1.3 trillion throughout the next decade. The growth is driven by Mr. Biden's two-part agenda to upgrade the nation's infrastructure and substantially expand the social safety net, contained in his American Jobs Plan and American Families Plan, along with other planned increases in discretionary spending. The proposal for the 2022 fiscal year and ensuing decade shows the sweep of Mr. Biden's ambitions to wield government power to help more Americans attain the comforts of middle-class life and to lift U.S. industry to better compete globally. The levels of taxation and spending in Mr. Biden's plans would expand the federal fiscal footprint to levels rarely seen in the post-war era to fund investments that his administration says are crucial to keeping America competitive. That includes fiat currency for roads, water pipes, broadband internet, electronic vehicle charging stations, and advanced manufacturing research. But it also envisions funding for affordable childcare, universal pre-kindergarten, and a national paid leave program, initiatives that Republicans have balked at bankrolling. Military spending would also grow, though it would decline as a share of the economy. Friendly reminder for those financial institutions too large to possibly exit and/or general bond market investors on how things worked out last time we blew out federal spending on this scale. During World War II, inflation compounded for years in the teens, peaking near 20% year on year, with nominal interest rates artificially pinned down near zero, effectively stealing future purchasing power from those holding government debt and IOUs. Something similar or worse is likely bearing down in the decades ahead for those who lend capital to the U.S. and/or other sovereign debt markets. The Federal Reserve will likely have to increasingly monetize debts and buy future certificates of confiscation, for interest rates cannot be allowed to rise without massive financial fallouts. Hello there, on behalf of SDBullion.com, this is James Anderson bringing you this week's SD Bullion Market Update. Before we continue, smash the like button so others can get this important bullion-related information served to them as well. Before we continue, the Memorial Day weekend and Monday holiday coming up is the final chance for you out there to enter our contest to potentially win a free 1,000-ounce COMEX Silver Bullion Bar. Click the link in the video description box below, enter your email address at our website, the contest, and now have a look at what a lucky contest winner is going to get to add to their bullion stack.
Ever wondered what a 1,000-ounce silver bar looks like? Yeah, it's big. SD Bullion is giving away a 1,000-ounce COMEX silver bar to one lucky participant in our silver bar sweepstakes. This bar is over 68 pounds of pure "can someone help me move this thing" silver goodness. So click the link below and enter for free, because someone has to win it, and you never know. It could be you.
Strong showing for gold, closing the week above the psychologically important 1900 handle. Silver closed near spot price resistance of 28 per troy ounce. The spot price gold-silver ratio climbed slightly to close the week at 68. After the U.S. Mint was recently overwhelmed by outsized demand for two of its newest numismatic silver coin releases, the Mint emailed customers the following letter, stating that the global silver shortage has driven demand for many of its bullion and numismatic products to record heights, also acknowledging that the demand for silver remains greater than the supply. So now we can add the U.S. Mint to those who have acknowledged the effective silver squeeze ongoing. This week as well, SD Bullion began offering the new Type 2 American Silver and Gold Eagle Bullion coins you see here. They are set to be shipped later this summer, toward the end of July 2021. The U.S. Mint has regularly run into a shortage for burnished silver bullion coin blanks from their vendors, such as the Sunshine Minting Corporation, which is currently relocating its manufacturing capacity and plant from Idaho to Nevada. As well, the U.S. Mint's motivation and legal charge to continually meet ongoing public American bullion coin demand got subverted just over a decade ago. The original 1986 law was amended in 2010, so that now the head of the U.S. Treasury, Janet Yellen, deems by fiat decree what is sufficient supply. In other words, it's unmotivated and legally not mandated to be cranking coins 24/7. The truth is that the U.S. Mint was never going to be ready for the big silver demand ahead. Instead, they'll be relegated to the side as big bullion buyers eventually go after the 1,000-ounce bullion bar category in earnest. In my studied opinion, that process has begun 2020 and now increasingly so into this year, 2021. The registered pile of COMEX silver has dropped another 2.26 million ounces of silver today. So since the silver squeeze movement began nearly 4 months ago, now around 45 million ounces have been withdrawn, and it's mainly from 2 warehouses that supply silver bullion rounds and bars to investment demand ongoing. As well, aside that, the PSLV closed-end Sprott Fiscal Trust Fund has continued adding silver to the tune of over 55 million ounces on the year, so these 2 facets alone reflect approximately net 100 million ounces of physical silver demand, and of course there are swaths of other silver investment demand suppliers swamped with demand ongoing like the aforementioned U.S. Mint, as well as other mints who've reported at times record high silver bullion demand such as the Perth Mint and Royal Mint, etc. Turning our sights from the ongoing silver squeeze to the building gold squeeze, this story is perhaps Basel III related, as it was reported today that gold bullion being sold to the BIS, the Bank for International Settlements, is likely working on behalf of some central bank clients, that they are buying out of the Bank of England. The gold bars are now selling at premiums many multiples of the norm, illustrating that perhaps those who need to buy physical bullion for delivery in size of 1 million troy ounces, or a bit more than a mere 31 metric tons, are going to have to pay larger premiums to get theirs. The article reads, Bank of England gold commands high premium, signals central bank buying. Gold stored at Bank of England has been selling for unusually high premiums recently, signaling that central banks may be back in the market buying. Bullion in the Bank of England's London reserves, one of the largest stashes in the world, is stored and sold on behalf of other central and commercial banks as opposed to being owned by the Bank of England itself. It usually trades within a few cents an ounce of the metal held at other London vaults run by commercial banks such as JP Morgan Chase & Co. But in the past week, gold sold from the Bank of England has traded for as much as 50 cents above benchmark London prices, according to bullion traders. These premiums are at least in part being driven by buying from Bank of International Settlements, which regularly trades the metal on behalf of the world's central banks, a person with direct knowledge said, asking not to be identified because the information isn't public. The BIS bought as much as 1 million ounces of Bank of England metal from various commercial banks at a premium of 30 to 40 cents recently, one person said. The premium for gold at the Bank of England rose as much as 50 cents an ounce late last week before tapering off to about 20 to 40 cents according to bullion traders. That compares with a range of 0 to 20 cents during normal circumstances, the traders said. A spokeswoman for the BIS declined to comment, citing client confidentiality. The Bank of England declined to comment, and the buying may be a signal that one or several central banks are increasing their gold reserves, bullion traders said. Overnight repo loan madness has returned to now record high levels, dwarfing both March 2020 levels and September 2019 through the beginning of 2020 levels, which you can see dwarfed here. If you recall repo madness September 2019, it effectively kicked off this sea change in bullion bullishness 2020s, and it occurred well before the COVID viral crisis. Here is the same data, but with day-to-day plots signaling the size ongoing. And what exactly is causing this? Jason Burrock of Wall Street of Main Street's YouTube channel tweeted at me the following 4 explanations. He tweets, there's 2 stories here. The mainstream financial media Wall Street narrative is that large banks in US and EU have so much cash that they have nowhere to park it. Other story is how there is now going to be a permanent repo facility operated by the Fed that non-banks use. The problem is how much leverage hedge funds, family offices, etc. use in their trades. It's easily 8 to 10 times on many of their trades, and they copy each other on exact same trades. Also, almost no hedge funds are actually properly hedged, mostly over-leveraged, unidirectional. For Repo Madness 2019, large hedge funds were caught with their pants down, over-leveraged on bond trades, with risky parity and the basis trade while QT was still happening and rates rose. Hedge funds were covertly bailed out then too, similar to February-March 2020. Because of the bailouts in 2008, 2009, large banks and hedge funds learned that another Lehman Brothers fail would not be allowed, so they keep leveraging up their trades and bet on being bailed out by a new liquidity facility. We'll continue monitoring this story ongoing. Turning to our final segment this week, yesterday the team at Incrementum AG, a European investment fund, published its 15th annual In Gold We Trust report. I'll leave links to the free 60 and larger 350-page downloadable PDFs in this week's video description below. We're just going to highlight a couple of the major charts that I found to be interesting, very long-term and looking outwards. As well, there's a few interesting quotes that they had in the report. It is written by fund managers Ronald Peter Stoffeli and Mark J. Valek. And they state, if the decade was plagued by stronger inflation, the price of 8,900 gold could be expected at the end of the decade. With the monetary economic climate change that we are witnessing this year, the risk of inflation is growing visibly. The analysts examined that the only way governments are able to deal with the growing debt is through financial repression. They state a look at the history books might answer the question. The U.S. ended World War II with debt at nearly 120% of GDP, while in the U.K. it stood at 250%. By the early 1970s, the debt to GDP ratio had fallen to about 25% in the U.S. and below 50% in the U.K. How was that achieved? The answer is by financial repression, i.e., by capping the yield on government bonds significantly below the rate of inflation. I might add that we touched on that point at the beginning of this week's update. They state that they believe that real interest rates will remain in negative territory for the next decade. In such a market environment, tangible assets, especially commodities, selected equities in the right sectors, and obviously precious metals, should form the solid basis of one's portfolio. Moving toward the 50th anniversary of the U.S. moving off the gold standard, no currency has been backed by a scarce asset like gold. Central banks can create fiat currency without any restrictions and are increasingly making use of this privilege. Now, turning to the two charts I wanted to highlight on this, we're going to start with the U.S. Commodity Price Index, a 10-year rolling CAGR. And I've gone and broken down what the Commodity Price Index is made up of. The majority of it is oil, but precious metals are involved in it. Hence, we all know that crude oil has dropped, at least last year, dropped a lot during the COVID crisis. But if we look at this, the shape is obviously, from overvaluation to undervaluation. And here we're at extreme undervaluation. And the estimate is that in the next 2 decades and perhaps more, the commodity bull market should be stuff of legend, going to a place of super overvaluation never before since seen. And if you just simply move to the next chart, the Dow Gold ratio, another chart covering about 220 years of time, it shows another of these movements of severe overvaluation back toward undervaluation. Severe overvaluation, for instance, in 1929, severe overvaluation in the Nifty 50 era in the 60s, severe overvaluation in the early 2000s, and somewhat of a dead cat bounce into another somewhat overvaluation in the stock market. But since gold is substantially high, we're near $2,000 an ounce, it's not as ridiculous as it got in the year 2000. They estimate, and I'm guessing they believe in the coming decades, that you will see the gold Dow ratio run back toward, well past its 2011 low and back toward its all-time low, potentially a 1-to-1 ratio, where the price of gold one day in the future potentially will be nominally equal to the Dow Jones Industrial Average. And that currently, let's take a quick look for a laugh. The Dow Jones Industrial Average is at 34,529 at the moment. So they are very bullish on gold and commodities. And just to finish this week, I'm going to give you a quick look at the 4 precious metals, the major precious metals, throughout this full fiat currency era. And of course, palladium as I've said many times on this channel, is leading the charge. But eventually, my belief is that we will also see gold, silver, and platinum all find new nominal price highs, eventually denominated in fiat Federal Reserve notes, which they continually create at ridiculous rates of size. So mind these charts and think about what this may look like coming decade or two for the precious metals. That's all for this week. Thank you so much for tuning in. As always, take great care of yourselves, those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.